The Honasa collapse signals a brutal reckoning in India's direct-to-consumer beauty empire, and the acquisition kill is a cash flow confession. On the surface, Honasa's decision to walk away from the 135 crore rupees, $16.2 million acquisition of Fluence Pharma appears surgical, a disciplined founder deciding that pharma adjacency doesn't fit brand architecture. That reading is wrong. The deal's collapse is a hard stop signal that Honasa's core business can no longer fund growth at the velocity required to remain competitive in India's DTC beauty market. Here's the arithmetic that matters. Honasa reported FY 2024, ending March 2025, losses of 221 crore rupees on revenues of 746 crore rupees. That's a 30% operating burn rate. Even with that baseline, the company still had enough cash runway, estimated 18 to 24 months on public filings, to acquire a 135 crore rupees asset. That they chose not to despite having liquidity suggests one of two things. Either their cash reserves evaporated faster than expected in Q1 to Q2 FY 2025, or the board explicitly prohibited capital deployment to preserve runway for core operations. Both are distress indicators. The timing matters too. This isn't 2023 when VC money was still treating Indian DTC as a growth at all costs category. Honasa's IPO, April 2024, raised 2,355 crore rupees, was supposed to be a war chest for consolidation. That they're not deploying it 16 months post-listing signals that growth capital has retreated and reinvestment must focus on defending unit economics, not expanding the TAM. The larger pattern: CAC to LTV compression. Across Indian DTC beauty, Honasa is Mama Earth core brand, 65% of revenue, Honasa Wellness, supplements, 20%, and a cluttered portfolio of smaller acquisitions, Aqualogica, Mama Essentials, the Dermaco. The company's valuation story, at 8,500 crore rupees IPO, was built on the premise that Indian DTC beauty customers had moved from impulse buys to repeat purchases and that margins could expand as scale improved. That premise is breaking. Customer acquisition cost, CAC, across Indian DTC beauty has roughly doubled since 2022. Instagram and YouTube influencer partnerships cost 80 to 120 rupees per customer acquired. Lifetime value, LTV, was estimated at 800 to 1,200 rupees per customer across an 18-month horizon. 2026, same influencer channels now cost 180 to 250 rupees per customer. LTV has compressed to 600 rupees to 900 rupees due to influencer saturation. Every beauty startup is now competing for the same 300 to 500 mid-tier creators. Rates have inflated 3x. Customer acquisition fatigue. The pool of early adopter customers willing to try DTC brands is exhausted. Growth now requires conversion of skeptical, price-sensitive buyers who churn faster. Margin compression. Amazon and Flipkart, where Mama Earth also sells, have forced price reductions. Gross margins on Mama Earth skincare products have fallen from approximately 65% to approximately 52% since 2023. Nykaa, the pure-play competitor, has managed better margins, approximately 40% net, but only by remaining diversified across makeup, fragrance, and owned retail. Honasa is skincare heavy and thus exposed to the worst dynamics: high competition, commoditization, and Amazon Flipkart's race to the bottom pricing. The following is why the Fluence deal broke, a clue into cash burn. Fluence Pharma is a contract manufacturing organization, CMO, for topical dermatology products. On paper, acquiring it makes sense. Honasa could improve gross margins by internalizing manufacturing, reduce unit economics dependency on influencers, and pivot toward pharmaceutical-grade positioning, higher LTV, lower CAC intensity. The deal was announced in Q4 FY 2024. By August 2026, it was dead. What happened in the intervening 8 months? 2 vectors. 1. Cash burn accelerated in FY 2025 H1. Honasa's quarterly burn is likely running at 60 to 75 crore rupees, extrapolating from FY 2024 annual run rate. With IPO proceeds around 2,355 crore rupees, That implies a 31